Intel reported quarterly financial results after the markets closed on Thursday, January 30th. The company's results were slightly ahead of the midpoint of expectations that management gave, but those expectations, those guidance that management delivered were not great to begin with. So in this video, I'll review Intel's latest quarterly financial results and update my recommendation for Intel stock. I'll let you know if I think the stock is a buy, hold, or a sell after these financial results.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Intel's management team, the co-CEOs, said that the fourth quarter was a positive step forward as they delivered revenue, margin, and earnings per share above expectations. The cost reduction plan we announced last year is having an impact, and this follows the forced resignation of the previous CEO, Pat Gelsinger, and now Intel's searching for a new permanent CEO. But until then, they're being run by co-CEOs trying to turn things around. The company's revenue in the quarter totaled $14.3 billion, which was down 7% from the same quarter last year. The operating profit margin came at 2.9%, which is down from 16.8% in the same quarter last year. But the good news was that the company generated $3.2 billion in cash flow from operations. This was much better than previous quarters where the company was barely generating $1 or $1.5 billion in cash flow from operations, while it was spending billions more in developing the foundry business, expanding manufacturing, and updating research and development in technology upgrades. So Intel is one of the few companies that's operating in the data center segment that's experiencing decreases in revenue. Intel is losing significant market share in this category to companies like NVIDIA. Intel's data center and AI market dropped by 3% to $3.4 billion. Now, that's as spending on data centers optimized for artificial intelligence are absolutely soaring. But despite that increase in spending in this category, Intel is not generating any growth here. Its latest chip optimized for artificial intelligence, the Gaudi, is finding it difficult to gain any traction. And so the disappointments continue for Intel stock investors. One of the areas where Intel is looking forward to generating significant growth are AI PCs, or PCs enhanced with artificial intelligence. And the company says they're on track to ship more than 100 million AI PCs by the end of 2025. The personal computer market is slowly returning to growth after a couple of years of decreases. Remember, in 2020 and 2021, people bought a lot of computers, and that created a gap, a sort of vacuum for demand, because so many people that wanted a computer bought one in 2020 and 2021. And since these computers typically last anywhere from 4 to 6 years, it's been a while since consumers looked to buy computers. But 2025 is the start of that replacement cycle, the 4 to 6 years replacement cycle that could fuel demand for PC sales, which would be great news for Intel. Another highlight for Intel is government funding, government grants and loans that they received to invest in their manufacturing expansion and manufacturing upgrades. Intel signed a definitive agreement with the US DOC, awarding the company up to $8 billion in direct funding under the CHIPS Act. Intel has achieved the milestones, receiving $1.1 billion in the fourth quarter of 2024 and another $1.1 billion in January of 2025. This is one of the major reasons why Intel decided to invest tens of billions of dollars in updating and expanding its foundry business, is because they saw an opportunity to do this at a lower cost because the government would fund some of that investment. So they were already behind in this category, and they knew that if they wanted to catch up, they needed to spend tens of billions of dollars, and they found an opportune time to do that. The difficulty is that it's a big investment that takes a long time for you to see the benefits of those investments, and investors have grown impatient. They've blamed Intel for investing too much too quickly, which has led to the company to be forced to slash their dividend and pause their dividend. Investors wanted or preferred the company to do this upgrade more slowly, more patiently, but they didn't. They went all in on this investment, and it cost the former CEO his job, which I think was an unfair firing, because coming into accepting that job, the CEO informed the board of directors, this is what I'm going to do. If you don't want me to do this, don't hire me as the CEO. The board of directors hired Pat Gelsinger, who proceeded to do what he said he was going to do, and the board of directors forced him out anyways. The semiconductor industry, most people in the industry believed that Pat Gelsinger was a great fit for this job, and now Intel is struggling to find a new leader that may not be as qualified as Pat Gelsinger was. It remains to be seen if they can find somebody that can fit this role. Intel is still trading at near its cheapest valuation it's ever been at, trading at a forward price to earnings of 12. And following these earnings results, the price movement is not that large, and so the valuation is likely to remain around this level. And when I did a discounted cash flow on Intel stock, I found the price to be undervalued. The current market price of $20 a share is significantly below the intrinsic value I calculated for Intel at $36 per share. So whether I look at the forward PE ratio or I look at my Intel discounted cash flow, it points to the stock being undervalued. However, I don't expect this stock to increase in value anytime soon. I think the company will take a while to get itself back together. In fact, I'm forecasting that the company will generate negative free cash flow for at least another 2 years. And then possibly starting in 2027 or 2028, will the company start to reap the benefits of these massive investments in manufacturing. So I have Intel stock rated as a buy, and I'm going to update that recommendation and reiterate the fact that I think it's a buy. But I think this is one of those high risk, high reward types of investments. It's a turnaround play, which are difficult to execute, and it's risky for investors. So if you're going into this, you have to be a patient investor that's willing to wait and take this risk that things will never turn around and Intel may never return to strength. If it does, then it can deliver great gains for investors. Again, high risk, high reward. It's one of those situations, but I still think it's worth the risk for investors long term. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.